All right, welcome back. We got our weekly stock market update. I did a midweek update where we talk a little bit more about the big rally we had on Wednesday, and that was mainly talking about the tariff pause that was implemented and causing one of the best days ever in the stock market. But it's been a crazy week. It's been a volatile week. I am drained. I'm fried. I'm ready for the weekend, so we're going to make this update short and sweet. Let's start off here by looking at the heat map. When we look at some of the individual names, it's a good mix here of green and some red. You've got healthcare selling off, energy selling off, utilities, some consumer non-durable selling off, financials look mixed, technology getting a rebound, and some of the retail names getting a rebound. So pretty mixed week here, but there were definitely some big moves in the middle of the week, but just volatility all over the place. We'll have Nasdaq had a 12% up day, and then the next day the circuit breakers almost triggered to the downside. We hit down 7% on the Nasdaq for just a couple of minutes. It wasn't long enough to trigger the circuit breaker, but we were flirting with it. So volatility very much alive and well this week. Now when we look at the ETF heat maps, pretty nice recovery here for most ETFs except for the bond market. Commodities are green, but the bond market just blood red. And when we look at crypto, Bitcoin pretty flat on the week, but it is making a nice move today. Let's take a look at some individual names. The Nasdaq, again, 12% move on Wednesday, and then we pulled back after that, and we had a nice recovery today. Same with S&P. Big move, recovery, big move, pullback, recovery, and we are now up 12% from our lows on the S&P 500, and it happened like that. And those lows were put in Sunday night, Monday morning. Crude oil, we are hanging around here in this low 60s. And gold, the star of the show here. Gold is killing it this week. Another all-time high today. Now let's go ahead and take a look at volatility. We are much lower from our highs, but we're kind of hanging around at these high levels. Typically, you see volatility spike and then quickly collapse. We're kind of hanging around at these elevated levels. So we'll see if we finally get a volatility collapse next week or the next couple of weeks, or if we keep chopping around here. But definitely just heightened volatility all over the place. Now the dollar, we haven't talked about the dollar in a while. Last time we talked about the dollar was over here, and we were wondering, was it going to break out or break down? Well, now we have our answer. The dollar is breaking down, and we will see if we can hold this support or if we keep going lower. And lastly, this is the most important move of the week. Is going to be the bond market. So we're looking at the 10-year yield. Just crazy moves. It keeps climbing up. And we don't know exactly the reason for this, but I know that this is not good. This is bad. We're seeing the yields quickly rise back up again. Now, either someone is purposefully selling bonds or being forced to sell bonds. So if you're a hedge fund or if you're an international bank somewhere and you have a position that you need to unwind and you need liquidity to other assets, the U.S. Treasuries is a perfect place for you to say, you know what, I'm down big on my NVIDIA position or my technology position or my oil position. I have to liquidate bonds to cover the losses on this other piece of my portfolio. Or if you're a country who just got tariffs slapped on them and you're upset, you could liquidate your U.S. bond position to kind of stick it to that country. So who knows what's happening? We won't know until after the fact, but this could also be inflation expectations, but the other signs to higher inflation is not there. So we see oil collapsing, we see the stock market falling off a cliff, we see the dollar going down, and then we see the inflation numbers actually coming in soft. So I don't think this rise in the 10-year yield is tariff fears, inflation fears. I think this is forced selling or purposeful selling of U.S. bonds. Now, the sad part about this is if this keeps going out of control the way it has been and we don't get a revert to the mean here, what will likely have to happen is the Federal Reserve will have to be the buyer of last resort of bonds to cool this market down. So they will have to bring out the money printer, crank that sucker, print a bunch of money, and then use the money that they just printed to go buy bonds that other people are purposefully not buying or even selling. So that's not good because it devalues our currency and it causes long-term systemic inflation. So all the government cost cutting, all the efficiency, all of that is pointless when you got to go print all this money and then all of a sudden the price to buy a house, your dollar doesn't go as far to buy assets because over time that printed money will find its way into assets, and just not quite a free market if you have to print money and buy your own assets. So anyways, that's a whole nother topic for another day, and we'll see if we get there. The Federal Reserve did make a comment today that they are watching the bond market and they are ready to intervene if needed. So they plugged in the printer, they didn't turn it on, but they're getting ready. So we'll see what happens with this whole fiasco here. We don't need to go over individual names. They're very similar to the whole market. But what I will say, we could use some individual names as an example. We did have a nice bounce, but we are still in a clear downtrend. I think Amazon, same thing. I had one chart where I illustrated this. We're still just kind of making these lower high, lower high, lower low, lower low. We're still in a downtrend. We've had nice rallies before, just like we did here, but while they puke it up. Nice rally, puke it up. Rally, puke it up. Rally, puke it up. Rally. You get my point here. Nvidia, same thing. Yeah, this was the chart I had. So we've had plenty of nice rallies that are followed by big sell-offs. We will see if we are at the peak of another nice rally that is followed by the puke of a sell-off. Who knows? Nobody knows. Lastly, let's go over the tariff news. Let's just wrap it all up with a nice bow here. So we talked about the U.S. tariff pause that happened on Wednesday, China's retaliation, 125% tariff on U.S. goods, and then the United States has increased their tariff on China to 145%. So obviously things are changing by the minute. Now for this week, we did have CPI come in. Great numbers on CPI. CPI came in at negative 0.1, so deflating, going down, which is good. And then PPI came in at negative 0.1. Again, good, much better than expected. Prices are going down month over month. That's good. And then we also had consumer sentiment. That came in weaker than expected. We've had plenty of weaker consumer metrics these last handful of months, and that is just continuing here as well. Lastly, we've got earnings starting up, bank earnings next week, and then we get into some technology names after that. Be very interesting to see what they say. And then next week, when we look at the economic calendar, we got a lot of Fed members speaking. I'm actually interested in this. I typically don't care what the Fed has to say, but with the volatility in the bond market, I'm very curious on what they have to say. And we've got some unemployment numbers on Thursday. So, and then whatever the Twitter machine brings us in between then. So I'm sure next week will be another chaotic week, but we're here. We're ready for it. So that is the weekly stock market update. I hope everyone relaxes this weekend. I for sure am ready to take a little break here. This has been a chaotic week, and I'm ready to cool off for a couple days and then get back to it on Monday. So everyone have a great weekend, and we will see you next week. Peace out.